Welcome everybody to my YouTube channel. My name is Raymond. I'm a realtor in the state of Maryland. And in today's video, we're going to talk about tips and give some advice regarding first-time home buying. So if you're a first-time home buyer, especially in the state of Maryland, looking to purchase a property, you came to the right place. We'll be right back. Welcome again to my YouTube channel. As I said, my name is Raymond, a realtor in the state of Maryland. And today I'm going to list some tips and things you need to know if you're looking to purchase your first property, right? First, I would say get your credit score up to 680 and above, right? 680 to 800. The higher your score is, the better chance you get you have of getting a loan and also a lower rate, right? Also, your debt to income ratio. So this is even before you get into looking for a house or anything of that nature. Get your credit score, preferably 700 or better, but 680 can work. All the way to 800, anything in between that should be good. Your debt to income ratio should be 30%. I think that's the best case scenario for you, or lower. If you can get a 43% debt to income ratio, most lenders will normally work with that. If your debt to income ratio is like 50% or more, that's going to raise some eyebrows and you may not qualify for a loan, right? So the DTI, debt to income ratio, I can do a separate video on that, but just to give you a quick summary of how to calculate that, let's say your debts include car payments, student loans, and credit cards, and that totals up to about $3,000 a month, and you make about $7,000 a month. You divide 3 by 7, you get 4.4286. You round that up, that's 43%, and then you can qualify, right? Because 43% is doable, 30% is ideal. Anything over 50%, good luck with that, right? So your debt to income ratio. So now you have worked on your credit, you lowered your debt, you increased your income, put away some down payment money, right? So for a first-time home buyer, there are some options. Let's say if you're a veteran or a spouse of a veteran, these are things that can eliminate a down payment with the VA loan. But we're not getting into that today. We'll do a separate video regarding the VA loan or USDA loan, meaning if you're purchasing a property in an agricultural area, you're going to need a USDA loan. But we're just talking about a regular consumer that's not a veteran looking to buy a house that's not in an agricultural zone. Most likely you're going to be going for an FHA loan. FHA is just the Federal Housing Administration. They insure loans, so they don't give the loan, they just insure it, right? And normally you can purchase a home or receive a loan by only putting 3.5% down. So the average price of a home in America as of December 2022 was $467,700. So 3.5% of that would be about, or exactly $16,396.50, right? That's what your down payment is going to be if you're trying to buy the average home in America. I would normally say save between $20,000 to $25,000. But if you are not a first-time home buyer, you're going for a conventional loan, you will have to put down about 20%. So that can be exponentially high, right? That's the difference between $16,000 and $80,000 on a down payment. Some of the pros and cons of an FHA loan we can get into at another video, but I'll just say this much. FHA loan, you got to pay like escrow insurance, which may bump up your monthly payments a tad bit. Sometimes you can refinance and get out of the FHA loan, but that's a video for another day. First time home buyers, work on your credit score, get your debt to income ratio at a 45%, 43% or lower. Save your down payment. It can be through your retirement. If you got a 401k savings, you can use that as a down payment. When it's time to purchase, you can just transfer it from your retirement fund to your bank. And sometimes banks can even pre-qualify you for a loan. This is a key point. They can pre-qualify you for a loan without you having that cash in your account. If you have that money in your 401k, all you need to do is show them your 401k statement. They can pre-qualify you because they know when it's time to purchase. 401ks normally transfer the money without any problem because they know it's for a home purchase. The government kind of allows that. So now you got your down payments. Next step is getting pre-qualified. Getting pre-qualified is going to a lender, and the lender is going to run your credit score. That's why we address that first. They're going to look at your debt to income ratio and then tell you qualify for X amount of money for the house loan. What this does now is it makes you in the know as to what you can afford. Because I find it ironic, you know, first time home buyers come to me looking to purchase a home, and everybody wants a nice home, right? I don't want to say some people are delusional, but you know, they say, oh, I want a home in, I'll give an example, the Potomac Bethesda area. Here in Maryland, that's a very affluent neighborhood where houses go for $700,000 and millions of dollars. Oh, I would, in great school districts. I would like a home in this neighborhood with an excellent school district, where the prices of the home are exponentially high and they cannot afford it. So I can just say, rather than going on a wild goose chase looking for homes you can't afford, get pre-qualified so you know what to look for. Even if you need a house or home in a Bethesda or Potomac area, maybe it may not be a single family home. It may not be a townhome. It could be a condo, being that you want that neighborhood. But if you need a home and you don't really care, well, you care about the neighborhood, let's say security reasons and things of that nature, but you can do a commute in a not so bad neighborhood, not so affluent neighborhood, but you need more land, more space, more rooms, you got a big family, then you can say, okay, rather than buy this $300,000 condo in an affluent neighborhood, I can buy a single family home in a not so affluent neighborhood, right? So get pre-qualified. That eliminates a lot of things. Also, what getting pre-qualified does is it makes you more of a, how can I say it? It makes you look better in the eyes of sellers, right? So if a seller has 4 potential buyers, 3 of them have no pre-qualification letter, you do, this seller is going to know this person is more likely to be able to secure a loan to purchase my home, and they're going to go into contract with the person who has a pre-qualification letter rather than somebody who doesn't. So that's the key in getting pre-qualified. It really helps you secure that contract, right? So now that you're pre-qualified, you then start to look for the property. That's where a real estate agent comes into play. You go view the property. I recommend a walkthrough. Don't go on the contract without physically walking through the house. It kind of eliminates questions as far as the condition of the house. You've already done your research for the neighborhood you like, the amount of bedrooms you may like and bathrooms, so on and so forth. Now you looked at pictures online. It's better to go walk the house because pictures can be deceiving. With all the things people can do with Photoshop these days, and as a listing agent, you know, we always advise our clients to, so we always tell our sellers to stage the property. So they prep it, they do some touch up on the paint, the cabinets, you know, they clean the house up really nicely and take very good pictures. These things can be deceiving. So I advise my buyers, walk the property. because when you walk it, you get to see things that are not in the pictures posted online that the seller may be trying to not hide, but disguise, right? So you've walked the property, it looks decent, you like it. However, looks are deceiving. You don't want to judge a book by its cover. That's why I say when you go to the next step, which is make an offer, I advise my buyers, make an offer pending inspection or appraisal, however you want to look at it, right? Reason I say that is when you make an offer for a property, you as a buyer will have to put down what's called escrow money. Escrow is money put down to lock in that contract. So there's a buyer and there's a seller and 4 potential buyers. This buyer is going to go under contract with one of these 4. This seller is going to go under contract with one of these 4 buyers. When the seller does that, these other 3 buyers cannot come and make an offer that will make the seller back out. If the seller backs out of the deal, they can be liable, for damages because they are under contract. They have to give a good reason to back out of the deal. On the other hand, if the buyer backs out of the deal and these other 3 buyers have now walked away, this seller has lost the opportunity to sell the house, right? And they may be going through tough financial times and are trying to sell so they avoid foreclosure. Now you as a buyer, you've walked away from this contract, and now you're going to cost this seller the entire house because they don't have any potential buyers anymore in a timely manner. And now the banks are breathing down their neck. So, or they may need to move out of town for a new job and they don't want to be paying 2 mortgages, whatever the reasons are. That's why that escrow money is needed. So this buyer is saying, I am going to go through this deal. And if I don't go through this deal, the seller gets to keep that escrow money. Not only the seller, but sometimes even the realtor, right? The seller's agent, because the seller's agent has done marketing, has printed out brochures and flyers for the showings, has done open houses, balloons and signages and food sometimes and drinks that they bring during the showings. And now you back out of the deal, they got to get compensated. That's all based on the agents. However, that escrow money, if you do see the process through, that escrow money goes towards your down payment. So for instance, as we talked about, your closing cost maybe $16,000. You put $3,000 down in escrow. When it's time to close, you're only required to pay 13 grand, right? Once again, at 16 grand, I would say it's 3.5%, but you're going to get maybe $1,000 or $2,000 in little fees here and there. So have about 20 to 25 grand. So now you made an offer pending inspection. The offer is accepted. Your escrow money goes to a title company. The seller doesn't get to hold your money. It goes to a title company. A title company is who transfers the title deed of the house. The title deed of the house is the same as a car's title. The title company transfers it from one owner to the next, right? So when you go under contract, that money goes into a title company's account and they hold it. Or it goes into a brokerage account, meaning one of the realtors gets to keep that money, but not in their business account, not in their personal account, in a separate account for title money only, right? So it's not money that they can touch. Any interest made on that title money during that time can also be applied to your closing, which is not substantial, because once the offer is accepted and you go under contract, there's normally a 30 to 45 day window to close the deal, right? So when you go under contract, the seller and the buyer, both agents, give a time frame by which the deal should be closed. This does a couple things. It gives the seller time where if this buyer cannot finance this loan in this 30-day period, I can not extend this contract and then look for another buyer. Or if the buyer has issues about the house that needs to be repaired, it gives the seller that time to do those repairs and move on, right? During this time, you're going to need an inspection, as I said, contract pending inspection. Now you get to send your inspector out there, certified by the states. They look at the property and say the roof needs some work. Now you tell the seller, hey, the roof needs work. It's going to cost 20 grand to fix the roof. Are you willing to drop the price of the home by $20,000? The seller said, no, I'm not willing to drop the price of the home. I can fix it myself or get a contractor to fix it. They fix it. The inspector goes back out there. Roof is fixed. You move on with the purchase. Or the seller says, I'm not willing to fix this property. No, I'm not willing to bring the price down. You can then back out of the deal and keep your escrow money. That's why that pending inspection language needs to be in your contract. Right? The FHA is going to require an appraisal. Why? Because the seller may say the house is worth $450,000. FHA sends the appraiser out there, or you as the buyer send the appraiser out there. FHA looks at the report. The appraiser appraised the house for $400,000 rather than $450,000. You as the buyer can then decide, I'll walk away from this deal. So you as the buyer can decide, I'll walk away from this deal. Or you can say, okay, FHA or lender, you're only going to give me $400,000 on the loan. I'll finance the extra 50 grand. That's up to you. But the FHA needs that appraisal report, one, to see things that are wrong with the house, and to see if they're going to give that insurance guarantee to the lender, and also what amount they're going to insure, right? So you do the inspection, and during this 30 and 45 days, you as a buyer are going to go through what's called underwriting. Underwriting now is where the lender gets to look at all your financial records in detail. A very detailed report, and it gets very intrusive into every transaction that they can look at. They get to look at all your bank statements. They get to look at tax returns. And something very key, between the time you got pre-approved to the time you close, I always recommend to my buyers, don't make any major financial decisions or transactions without consulting your lender or your financial advisor, because these spikes in credit cards expenditures or any big purchases get to affect your credit score, get to affect how much money you can qualify for, your debt to income ratio. So just because you got pre-approved for $450,000 doesn't mean you will get approved for 450 grand. When they start really digging into your finances, they may see some red flags that can drop the amount you qualify for. So during the time of you looking for a home, you should just work on saving, work on getting a better credit score, work on decreasing your debt to income ratio. Nothing that would affect your credit record or how much money you can afford. During this underwriting period, if they see a $5,000 deposit that didn't come from your job, they're going to want to know where it came from. Sometimes that money is not even approved. They wouldn't even take that money. I'm telling you this of personal experience. When I was purchasing my home, I received like $3,000 from a friend. That wasn't used. They said, we cannot prove this. Let's see your friend's financial record. And the person wasn't willing to do that. I said, okay, don't worry about that 3 grand. I got this 3 grand from here, a source that they could prove. There's something called gifting that they accept. Gifting is like your parent can write you a check. A friend can write you a check. But now they're going to probe into where that friend got that money from. The reason why they do that is so people don't launder money. Through illicit criminal activities, they get money and purchase a home through somebody's name. So the bank is trying to eradicate those options. And therefore, whoever gives you money for down payment, they want to know their financial record. It gets really intrusive. They really look into a lot. And sometimes, I know a lot of minorities go through this at times. They feel as though the banks are being racist. Not to say these things don't exist, where lenders favor a certain type of people and the other, but they really just have to do this because they're loaning a substantial amount of money to people. So I don't want to say that those practices don't happen, but really don't take it personal. The banks really got to watch out for themselves. So does the FHA that is securing the loan. And if you feel as though there are any malpractices going on, there are a lot of ways of reporting that. So don't take this part too personal. Just look at everything being up and up on your side. But if you feel as though I got great credit, I got great debt to income ratio, my income is fine, I couldn't qualify, then you can go seek out a lawyer or something to go and probe into who's not being fair to you, right? But underwriting is very tough. Another thing to look out for, some lenders are called secondary lenders, right? Meaning they lend you the money and then they sell the loan to another bank. So you'll find out you're closing the deal with bank A, but as soon as you close, you get a bill from bank B because they have now sold your loan. They don't want to wait the 30 years to get their money back. So if 30 years and your interest rate is going to yield that bank or that lender $50,000 or $100,000 through the life of that loan, bank B can come and say, okay, you're supposed to make 100 grand in 30 years. We'll take on that 30 year. I'll give you 50 grand right now just to own that loan. So these banks normally shop your loan out, right? So during this 30 to 45 days, while you're waiting, the banks or lenders are sometimes looking for a second party to sell your loan to. And if they don't secure that in time, sometimes they act as though you don't qualify. You do qualify, but they're now trying to shop your loan because some of these secondary lenders, they're not trying to sit on your loan and try to shop it to somebody down the line and can't find a buyer for your loan because they need that little 50,000 here and there on each purchase to keep on floating. That's how they do business. So sometimes you want to go to a primary lender, somebody that has their own money that can give to you. These are things you need to look for when you are looking for a lender. Because if this company has their own money, they give it directly to you, no delays, no nothing. But if this company is looking, they do have the money, but they want to shop your loan and sell it to somebody else, they drag their feet. And that happened to me when I was purchasing a home. So I'm telling you this now. It came to a point where we had to extend my contract twice. And the third time, the seller's like, look, I think you're a viable buyer. I think you got the money. I don't trust your lender. I don't know if they want to finance this loan. So the seller's agent told me this. In the best interest of my seller, I can't extend this contract anymore. So I told my lender, hey, they're not going to extend the contract anymore. And they finally financed the loan. But exactly what I thought was going on, they sold it to another company. Right? So I think that time they were dragging their feet. They were literally trying to shop the loan out. So these are just things to look out for that the regular agent may not tell you. And I'm just saying this because these are things I've gone through as well. So after underwriting, you're now qualified. It takes 3 days after your loan has been approved to go to closing. Closing is normally done at the title company's office, right? The seller, the buyer, the title company. It can be seller, buyer, seller's agent, buyer's agent, title company, whoever you want to represent you. But at the end of the day, the signature needs to be between the seller and the buyer. The title company normally provides a notary specialist who says, okay, I was there to witness this deal, and they notarize the transaction. The seller gets the money, obviously not physical cash, things wired to them. The buyer gets the keys and deeds to the property, and then you get to move into the house. Well, I hope this video was informative. That's the buying, first-time home buyer, first-time home buying process, I should say. And as you've already heard, there's so much more I can elaborate on and will elaborate on moving forward. So stay tuned. Make sure you subscribe to the channel and leave any questions or comments down below so we can address topics you may need me to cover. Thanks for watching. Have a blessed day.